In today's video, we'll examine the common risk management mistakes a retail trader makes while trading and how to avoid them in practice. We all know that trading in the stock market is like running a business. However, some traders still treat it as gambling, hoping to become millionaires in a day, focusing mostly on making large profits. However, an experienced, profitable trader focuses on risk management before entering a trade, deciding when and how much loss to take before exiting. On the other hand, a beginner trader holds on to loss-making trades in the hope that the market will eventually reverse and they will surely make a profit. This hope only exacerbates their losses. Similarly, a beginner trader makes many other mistakes. So let's try to understand these mistakes step by step. Let's dive in. But before we move on, if you find this content helpful, smash that like button, and if you're new here, don't forget to subscribe and turn on notifications so you'll never miss our latest uploads. I'll see you right after the intro and disclaimer. Mistake number 1 is not safeguarding trade entries based on the price shown in this chart. After forming strong bearish candles and facing rejection at lower levels, a green bullish candle appears with long lower wick rejection candles. At this stage, the price repeatedly rejects from the lower zone and tries to create support on the downside. We now have two retail traders, each with nearly $50,000 of trading. Since the market can push higher by holding this support area, one trader takes a long entry by placing a stop loss below the green candle, expecting a reversal. The other trader enters without using a stop loss, thinking, if the price breaks this support, I will exit my trade then. However, the very next candle forms a strong bearish momentum move, driving the price lower. The first trader's stop loss is triggered, resulting in a loss of $100. He accepts it and exits the trade. The second trader, who entered without a stop loss, keeps holding the position as he believes the market is still consolidating. From here, the price slightly rises, giving him temporary profit. Soon after, the price reverses again, forming another large bearish momentum candle and sliding sharply downward. With theta decay accelerating, the option premium drops quickly. Watching his losses build up, he panics and exits. The second trader ends up losing more than double the amount the first trader lost. The first trader only loses 100, or 2% of his capital, in this trade. But the second trader loses 3,000, nearly 6% of his account. While this may appear small, if both traders lose 3 trades in one session, the first trader's drawdown will be only 6%, or 3,000. The second trader, however, will face an 18% drawdown, nearly 9,000, or even more in 3 trades. Such a massive loss is very difficult to recover from. On top of that, the psychological damage faced by the second trader far outweighs the capital loss. Here, proper risk control plays a vital role. By applying risk management, the first trader's downside is capped, but the second trader, ignoring risk management entirely, suffers a heavy loss. This also deeply impacts his trading psychology. While most retail traders are aware of this concept, they still fail to protect their capital in live market conditions. Let's now move to the next risk management mistake. Mistake number 2. Oversized position. A retail trader has total trading capital of 1 lakh. After observing market price action, he decides to take an entry at a certain level. With a stop loss and profit target in place, he commits his full capital to trade options, purchasing lots worth the same amount. Once he enters, the market initially moves in his favor and he sees profit on the screen. But since he has risked his entire account and entered with such a large position size, he feels anxious that this trade could turn into a loss. Out of fear, he exits quickly with a small profit. However, right after his exit, the price surges further in his direction. Now, he has no choice but to regret it, because the market has moved so far that re-entry is not possible at that level. This is why, whenever you plan a trade, you should never put your entire capital at risk. Ideally, you should use only 40 to 50% of your account in one trade to manage risk effectively. Once in a position, trade with a quantity that you can hold confidently until your profit target, without fear. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 18th. This isn't just another course, It's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before October 18th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Mistake number 3, fear of loss. In this chart, you examine the price action at a certain level and decide to take a long entry. After some time, as per your analysis, the price revisits your entry zone. But out of fear of losing money, you hesitate and avoid entering near that level. Later, the market moves in your direction. It goes upward while you keep watching. But eventually, seeing the momentum, you lose emotional discipline. Without managing risk, you enter at a price higher than your planned entry. The market rises slightly more, then starts to reverse. Because your entry was at a higher level, your stop-loss distance becomes much larger. After a minor pullback, you panic and exit due to fear. Immediately after your exit, the price continues upward and hits the profit target you had originally planned. This is something most traders go through. That's why, if after proper analysis the price comes to your entry level, you should enter near that zone without fear, while following risk management. If you fail to take the trade there, the best choice is to skip it. Mistake number 4, random trade entries. If you want to be profitable in any form of trading, you must build a trading plan and stick to it. In this chart, you analyze a long trade and enter accordingly, but your stop loss gets triggered. Again, after analyzing, you enter a trade, and once more your stop loss is hit, leaving your P&L in red. Despite analyzing properly twice, your trades end in losses. To recover this loss the same day, you start entering random trades without a clear plan, which only increases your losses further. By the day's end, your account faces heavy losses that hurt your trading psychology. Therefore, if your stop loss is hit 2 to 3 times consecutively even after correct analysis, avoid trading further that day. Instead, in the evening, calmly review your mistakes and work on not repeating them the next day. Mistake number 5, overtrading in intraday. Many new traders see profits in the first half of the trading session due to high volatility, which boosts their confidence. But as soon as the second half begins, overconfidence leads them to take random trades without analyzing price action, causing losses. In an attempt to recover, they keep entering trades even without proper setups on the chart, which only deepens the loss. Due to these repeated mistakes, some traders get frustrated yet come back the next day and repeat the same behavior. This is why you should never chase the market. If you face losses in a session, accept a small loss and stop trading for the day. Accepting losses calmly is the first step to becoming consistently profitable. That's it, traders. Thanks for watching this video. Growth doesn't come from watching, it comes from applying. If this video gave you a new idea or pushed you one step forward, hit that like button and show some support. And if you're new here, subscribe and turn on the notification bell so you don't miss what's coming next. Keep showing up for yourself, because consistency pays off more than motivation. I'll catch you in the next video.